For over 30 years, Japan was the global poster child of deflation and value traps, where most capital went there to die. But looking at data in 2024 and 2025, we may be witnessing a bit of a renaissance and an end of an era where wages are rising, earnings are actually growing, and inflation is finally sticking. And here's even a better catch, that the Tokyo Stock Exchange is finally forcing companies to unlock more shareholder value, more capital allocation efficiency, which is something they've never done in the past. So what we're witnessing here is really something, as an investor, it might be an opportunity for you to enjoy that growth. But be aware, if you buy a broad-based Nikkei 225 kind of ETF or index, you may be missing out on certain niche companies that may be outgrowing the rest of their peers within the index. So stay throughout the video. I'm going to share with you my thoughts on what I mean by high-quality Japanese industries or businesses that are very likely to poised to enjoy the growth of this Japanese renaissance. So one of the first catalysts we're witnessing is actually the transition from deflation over to an inflation number, where you see real wage growth. And I think that it is the marking of an exiting of a lost decade era into something of a normal renaissance and growth period for Japan, no matter how slow it is. Because unless you see wage growth, you're not seeing any nominal GDP growth within a particular country. And it's expected to continue in 2025, 2026. Over and above that, what we're seeing is the Tokyo Stock Exchange forcing capital efficiency. Now, what do I mean by forcing capital efficiency? Because most Asian companies or businesses, they tend to be a little bit more conservative, and they like to keep piles high of cash on the balance sheet. But as an investor, when we see that, it's actually a company not being very efficient. It's either, if you don't know what to do, you don't have a capex plan, or you don't have a business scaling expansion plan, return that to shareholders, or do share buybacks to reduce shareholder count and to increase earnings per share. So because in the past a lot of Japanese companies didn't do this, you see companies trading below less than 1 price to book, and the Tokyo Stock Exchange has started a list of naming and shaming these companies that were not capital efficient. And that what we're seeing is that is starting to have an effect. And you see record share buybacks in 2024, 2025, and there is a lot of unwinding of these inefficient capital structures. So we're not just buying cheap in Japan today, we're buying a structural shift in how Japanese corporations actually treat shareholders and managing their balance sheet more efficiently. So that's catalyst number one. So part of my investment hypothesis or investment philosophy is that I like to see high ROICs. Now, if you haven't have a clue of what ROIC is, check out the video on the link on the left or on the right. I'm always not sure which direction it is, but it's going to be up there. So one of the first quantitative bases I look for any company or any businesses to invest in is they would have to have at least 10 years of high return on invested capital, or ROIC, that is more than 15%. The higher the better, but if there is an exception to the rule, perhaps it was at a growing stage where they need to invest a lot of capex, then I'll do an adjustment. But by and large, more than 15% over 10 years, and an earnings growth of at least 5% over the past 10 years. So the core message I'm trying to send is that you cannot buy broad-based just because the Tokyo Stock Exchange is forcing or naming and shaming. Not all companies are going to have that kind of growth and therefore attached to quality. So why Japanese stocks have always had this trouble of having high efficient ROIC is because they're very, very conservative. You want to build a new factory. Wow, are you sure you're going to get in the demand even though we increase the supply? So these were the parts where a lot of Japanese businesses were just holding back. They had low ROIC, low return on equity, little bit poor corporate governance. I mean, there's scandals like the Olympus scandals, mark to market, hiding things on the balance sheet. So we want to avoid all these melting traps. So we have to anchor it along quality companies, quality Japanese companies. And what we're seeking for is really this premium tier. They have a strong balance sheet, not just piles high in cash, but efficient. All right, they have very good free cash flow, ROIC well above 10-15%, as I mentioned earlier. And if you can, right, find it at a fair valuation price. So the other way I look at it is really the quality. Does it really have the moats, competitive moats, and it will tie together with all these quantitative numbers that I told you about. So yeah, not broad based. These are the criteria for high quality, and these are the things that you should look for if the catalyst you should look for if you were to look for Japanese companies. So the second area I want to look at is the popular belief that Japan's shrinking population is a negative thing. But I see it as a tailwind for it being an automation leader, and that is the counter to them suffering from a declining working population. So historically, if you look at the four strongest nations in terms of robotics, which is Japan, Germany, Switzerland, and now US and China, they realize that you need to be efficient, especially in low value, repetitive, mundane tasks that you can automate away. I mean, that is what we're seeing in factories. But what we're seeing more and more are these things called cobots or collaborative robots, where Japan's aging population is actually a very good market demand creation, because you need more workers in the healthcare sector, geriatrics care, and this is where Japan, ironically, really, really excels. They have been doing this, creating sensors for long periods of time, creating automation tools, automation hardware that have benefited the global manufacturing industry, including China, right? So look at the Japanese incumbents, which are very, very strong in terms of robotic automation. And even if I go to any Penang automation house that builds either CNC or they provide CNC machinery, or they provide manufacturing services, I will never fail to see some of these names like Fanuc, like Omron, like Yashikawa Robots, or even the Swiss names like ABB, or the German names like KUKA, which now belongs to the media group. So all these cumulatively are helping propel this phenomena, declining population, aging population phenomena, and automating a lot of the low value, lower margins kind of labor force. So yeah, what we're seeing is rising R&D spend in Japanese robotics automation companies, but we're also seeing threats and cheaper alternatives, but equally as high or even better quality from the Chinese as well. So this is where I would look at in terms of niches for the Japanese investment hypothesis. The second catalyst or niche that I think Japan really stands out in terms of global dominance is really their material science and actually chemical engineering, chemical manufacturing. Now, for those of you who are unaware, a Japanese was actually awarded the Physics Nobel Prize for creating the blue LED that enabled the manufacturing of the white LED that compounded or galvanized what we know today as our OLED screens for TV, for smartphones, for any devices that has a display. So it has been a strength, a quiet strength for the Japanese. And also, there were a lot of chemical innovation that came out of Japan post the Second World War, and these have actually powered, photography, manufacturing, textiles. So these are what I feel are niche industries that Japan can really outgrow, because even with competition from China or other countries that may be cheaper in terms of labor costs, they have held their head high. Yeah, they have lost certain niche industries like battery. They have lost it to the Chinese because, 2 or 3 very, competitive, globally minded, innovators in China have actually surpassed them. The guys like CATL, right? They've surpassed people like Panasonic or the Hitachis of this world. They used to be dominant in all these industries. But by and large, chemical and material science in Japan is really, really strong. And this is something that I think we, as investors, should look at the vertical niche, vertical integration to other industries that are globalized in nature, that are still growing. And these are where earning growth potential is going to be high. And I think that's where their competitive advantage really is. I mean, these are hidden players. They don't have brand names that come to your face in a consumer form. Find those vertical niches, and that's where riches are made in niches. So the third catalyst are actually Japanese consumer brands that have scaled outside of the domestic market. And one brand that I'm very sure most of you are familiar with is actually this brand called Uniqlo. under the listed holdings called Fast Retailing. My family loves to shop there, and my biggest regret was not putting a position earlier when I saw that demand. But what was holding me back, and the lessons I've learned, was that, you know, even though textile is a very competitive industry, I mean, if you look at Gap of the US used to be, you know, large back in the day, but today they are just a shadow of what it used to be in the past, right? So that was my fear of, you know, buying into a consumer brand, very competitive, very tight margins. But Uniqlo defied the odds and really scaled globally. Okay, the other brand that I think has pivoted and survived over this long period of time is the company that created the Walkman. It's none other than Sony. But if you look at where Sony is, you know, you really have to respect where they have pivoted, where they've survived. They're into cameras, they're into speakers, they're into, you know, consumer electronics, they're now into gaming. And, you know, who doesn't know, any kid who doesn't know a PlayStation, you know, probably living under, not urbanized, not having, lived in the city, you know, but everyone who is urbanized and lived in the city, I'm very sure they heard of the PlayStation, right? So the core message I'm trying to send is that Japanese brands that have managed to scale globally have escaped the domestic shrinkage of this population decline. And I think overseas sales now make up a majority of the revenue contribution to these companies. So these are just two examples. They have also massively expanded into China, Southeast Asia, and this power or competitive advantage that they have is really this network economies and branding, this intangible asset that they have. I think these are guys that will continue to be able to scale as long as they stay hungry, they stay innovative, and that's something that as an investor I'm excited to see the next phase of growth for these companies. So while I've talked about the growth catalyst for investing into the Japanese market and what the Japanese exchange is actually doing, naming and shaming, we also have to look at what are the risks investing into the Japanese market. I think the first risk is really the currency volatility. I mean, with the new Prime Minister going to announce an election, she's already announced the election, they're going to have an election. That political uncertainty, as well as monetary policies that will impact the Japanese yen, that volatility in itself will actually put a certain risk into corporate earnings, into capital markets for Japan. I think Japanese yen has been, a lot of tourists would like to monitor the Japanese yen because it's a favorite tourism destination. But as an investor, I think the further decline of the Japanese yen will erode whatever investment returns that you will be getting from if you invest in the Japanese market. So if you follow the investment hypothesis of finding Japanese companies that are exporters rather than just focus on the domestic market, I think that risk can be mitigated because a lot of their sales is either foreign currency denominated like the US dollar or whatever foreign markets that they are in. I think that will offset that kind of risk decline. The second risk for me personally is if you understand the Japanese working culture, business culture, is that the moment someone works for a company, they're set for life, right? There's no hire and fire like the American culture. It's much more, societal, familial values, and even if the worker is inefficient, they don't fire the workers out of respect. It's just a cultural norm. So because of that, inefficiencies within the business are bound to exist. And I think this risk is mitigated by a lot of the automation that I mentioned earlier as a catalyst. So more and more as this group of workers start to retire, then the efficiency will normally come up by itself because they won't hire new young workers. Instead, it will be replaced by automation. And I think that's how you mitigate this particular risk on labor inefficiencies and the non-firing culture that we have in Japan. The last risk I'd like to highlight is in terms of culture of competition and versus conservatism. I think the Chinese or the Americans are a lot more aggressive in terms of taking onboarding this kind of risk, whereas I see Japan are likely more conservative. They're much, ironically, much more like the European counterparts, where the Europeans are a lot about a little bit more socialist in terms of their policies, in terms of their culture. And I think that's what's holding a lot of domestic driven Japanese companies from scaling globally. So I think that's the risk that you have to find owner operators, capital allocators within these Japanese businesses that have a global scaling appetite, that have particular appetite to undertake risks that they may not be aware of, rather than just focus on the Japanese domestic market. And this is a key risk that has held me back. I think the only way to mitigate, rather than just reading, is actually to have boots on the ground, travel and meet these owners. Do they have that kind of vision? Do they have the kind of enthusiasm to actually scale and grow their businesses? So yeah, those are the three main risks that you should look at, especially investing in Japan. So to conclude, alpha is really the divergence between price and quality or value. And what we're seeing is a convergence of governance reform, the end of deflation, the rise of inflation, right? Sticky inflation, and the rise of companies that have this technological and commercial moat that can scale globally. So furthermore, you see the Japanese exchange itself realizing that to attract capital to invest into Japanese listed companies, you have to make these companies more efficient rather than sitting on a pile of cash and doing nothing. I think that inefficiency is also further compounded by the little coverage that the Japanese market. I mean, for 30 years, a lot of funds have just left the Japanese market. There's very little coverage on a lot of these listed companies in Japan. And I think that's where the gap that you and I can actually exploit to find those alphas, to find those companies that have been undercovered and yet scaling and growing their earnings. So I will sound like a broken record, but the philosophy that I've adopted and it worked well so far, over the past years that I've invested, is really buying high quality businesses, high ROIC, and use that framework and template to look at undercovered companies in Japan, mitigate the risks, and allocate a certain percentage of your portfolio there and ride the tailwind together. So what are your thoughts? Are you invested in Japan through a fund, or are you invested in a particular specific stock in Japan, or you've completely not on your radar, completely avoided the Japanese market all this while? Let me know your thoughts in the comment, and looking forward to seeing you in the next video.